Given the mixed signals that we're getting from economic data, whether it's the ISM services number today against improving S&P global PMIs and the mixed jobs report, how difficult is the job of the Fed right now?
It is difficult, but I think that it is time for them to skip. I believe that the market is anticipating that they need to skip. It's not a pause anymore. We used to say pause, which means they would not raise again. Now we think they're going to skip and they're going to be more data dependent because, like you said, we are having conflicting data. The core numbers didn't come in. They actually went up a little bit. And now, of course, we have CPI the day before the actual Fed decision. So we need to see what happens in the future. But we feel that they've raised enough interest rates that they will skip in June, but possibly, depending on the data, see what happens in July.
With rates rising, does it make sense to keep adding to tech stocks? Of course, we've seen that huge rotation back into these giants.
Yes, because they still have the most predictable earnings, and they're still growing. And the amount of interest rate increases, even if it happens, is so small comparing to the 5.25% interest rate increases we had last year. So even if the interest rate went up another 0.25%, it's not going to derail their earnings like it did last year. It is time to actually be back into big tech. And of course, the market is definitely has taken it to much higher levels. We think there's going to be maybe a little bit of pause in those prices here for a while because they've run up so much. But long term, we still think tech is a place to be for sure.
More broadly, we've got a record amount of shorts on the S&P at the moment. Does the market look overvalued to you right now? Are there any pockets that you're avoiding?
Well, we're still avoiding the financials and the regional banks with the news today, with the additional deposits they'll have to make, the reserves. This is an area that's not going to perform well. It's going to cost them quite a bit of money to do business, and people are staying away from regional banks. They're still worried about the risk. So we're staying away from regional banks and financials in general. But we still, and the market, as you know, maybe 7 big stocks have contributed to the upside in the S&P this year. So there's a lot of undervalued stocks. For example, we like energy right now, which really has not done well. We think it's time for it to recover.
Yeah, in terms of energy, we had another production cut from Saudi Arabia at OPEC Plus. What's your outlook for the oil price this year?
We think it's certainly could firm up a little bit from here. We do think that there's maybe more cuts from the OPEC countries, and there's certainly going to be more demand for energy. And China, although it hasn't come about like we thought it would, is still China might have a stimulus package which will increase its GDP and the use of energy. So we think it has some upside from here. Not tremendous like it did last year, but certainly some upside. And with good dividends, energy stocks look undervalued to us right now.
Laila, a point of support for markets has come from strong earnings, but now we're getting even calls from Morgan Stanley that we might see a sudden pullback when it comes to corporate earnings. Should we start becoming a bit more concerned and position more defensively?
You know, people have been saying that all year, and they've been doing defensive, and they've been calling for recessions, and we really don't see it. We see actually a higher GDP next quarter. There's still $500 billion of savings that investors have to spend in households. Certainly employment, there's jobs, there's 1.6 jobs available for every person looking for a job. So there's lots of jobs out there, and people are making more money because of inflation, they're getting paid more. So earnings should follow. And the recession that everybody thought would happen, it looks like it's not going to happen and maybe delayed. And that's why the market is starting to behave a lot better because, you couldn't have, everyone thought we would have a recession by now, and we don't see it. So earnings should do better because we're not going to have a recession.